Good afternoon, everybody. My name is John Foster. I'm a co-founder of Smartkarma alongside my friend and colleague Raj Kapoor. I'm delighted to introduce today Osbert Tang. Osbert's been a Shanghai-based analyst since 2003, focusing on China for more than 20 years. He's held senior leadership positions with ABN AMRO, RBS, Maybank Kim Eng, and Moody's. Osbert's got expertise across asset classes, focusing both on equity and credit, specifically China onshore credit markets. We're very proud to have him as an independent insight provider on Smartkarma. We're going to continue the afternoon's track on sustainable recovery, and Osbert's going to focus on the opportunities available in China's construction machinery sector as China starts to ramp up fixed asset investment. So, Osbert, over to you.
Okay, thank you, John, and thank you, Smartkarma. Good afternoon, everybody. It is my pleasure to speak in the Sustainable Recovery track of the Insight 2020 conference organized by Smartkarma. Over the next 20 minutes, I'll share with you my thoughts on the China construction machinery sector, and which is a beneficiary of the overall China's inflationary measure. Over the next 20 minutes, I'll just share with you in terms of the overall outlook in the China's construction infrastructure machinery sector, and then that will follow up by a brief Q&A session. And then when we talk about inflation, it is important to look at which I would say one of China's key policy instruments, that is FAI. The importance of FAI to China's growth is actually quite significant. If you look at last year, despite China's continuous effort to boost the overall consumption, FAI is still accounting for about 56% of the total GDP in China. Although that has slowing down in terms of the growth, it is lower than like 13.3% for the net export growth, as well as 8% growth in consumption. However, it still accounts for quite significant portion of China's GDP in last year. If we look at this year, we continue to see that the infrastructure will remain very important in China's overall inflationary measure. The COVID-19 outbreak has negatively affected infrastructure FAI in the first quarter, but there is a strong rebound in April. If you look at the first 4-month number, the FAI drop is around 11.8%, but that has already compared with about 19.7% contraction in the first quarter. So we do see clearly a pickup in terms of the April momentum. Now, the government also want to finance the more infrastructure spending through the special purpose bond issuance. The country has already stepped up the issuance of special purpose bond in this year. For the first 4 months of this year, total special purpose bond issue reached about 1.3 trillion. That is roughly up by about 72% year on year. If we look at this month, the Ministry of Finance has already speed up the allocation of the special purpose bond quota with the batch of about another 1 billion allocated to the local government at the end of April. The target is to complete the issue by May. So what we see is that actually they were quite forceful in terms of the new special purpose bond issued. But what about the areas that this kind of bond proceeds will be used? In fact, the focus will very much on infrastructure spending. Special purpose bond in China mainly is used by the government to invest in some of the construction of more specific projects instead of some kind of general government usage. If we look at the breakdown of the usage, infrastructure, particularly infrastructure in relation to transport, is one of the key areas that the government is going to spend the proceeds. And then that was followed by other areas. If we look at the bigger two actually urban infrastructure and transport infrastructure account for roughly about 67% of the total proceeds used raised from the special purpose bond in China. Now, going into the construction machinery sector, we do believe that the increase in FAI infrastructure will help to boost the demand for overall infrastructure as well as construction machinery industry. If you look at the April sales, the industry sales for both excavator as well as wheel loader recorded quite significant rebound in the month. That is actually a monthly year-on-year high in the last 12 months achieved in April. Looking at just excavator, the growth was about 60%, close to 60% in April, year-on-year in that month, while wheel loader sales also increased by close to 30%, 31%. Both of them are mostly driven by the domestic market demand. Export demand was actually still quite weak. We see some minor drop for demand in export in April, mainly due to the COVID-19 outbreak in overseas countries. So this will still be weak as we expect it over the next couple of months in terms of the export, but domestic market will remain solid. What about future in terms of the outlook? We see that the rebound in excavator sales has been across all different product types. Particularly the recovery of the large size excavators are the strongest in April, and they are driven by more in relation to like real estate as well as mining industry. Going forward, we actually expect that because of the acceleration of infrastructure development and investment, in the next few months, that will drive the medium-sized excavator as they are positioned for more on the infrastructure use. So we do see that generally all across the board having very strong improvement in terms of demand, and particularly next few months it's going to be more the medium size with focus on infrastructure area. Now, in fact, some of the industry participants has positive guidance on demand, generally talking about that. Normally, at this moment of the time, historically, like in last year, many companies still have close to half month to 1 month of inventory. But now the demand was so strong that they will actually immediately, when the products are out of the factory, will be delivered to the clients. These are shared by some of the different leading companies within the industry, which also suggests that overall momentum will continue to be strong going into the next couple of months. An interesting phenomenon is that we see that in April, the construction machinery companies has already announced increase in pricing of the excavators by about 5% to 10%, depending on the size. The interesting thing is that even with the price increase, the April sales still very, very strong. So that actually reflects a very strong underlying demand market. Also industry discussion that by June, there will be another round of price increase. And that is actually to reflect the shortage of engine as well as the overall demand surge. So both a combination of the price as well as improvement in volume will be positive to the construction company, machinery company in this year. Now, what about the margin as well as profit outlook? We are actually looking back into the SARS outbreak situation. Based on the experience in 2003 after the outbreak of the SARS, the profit for the construction machinery sector actually has been solid in the year of the outbreak, even in the year of the outbreak. And the next year, that's on the back of the government's infrastructure boost investment. As for this year, we also expect good margin improvement, as we can see, as I share with you, in terms of the overall product volume as well as pricing improvement. And that would be driving the overall profit growth. Consensus focus now looking at roughly about 14% EPS growth for the whole sector, but I think this is actually look quite conservative given the expansion in margin and positive volume, as well as the potential for future further price increase in the second half of this year. In terms of specific company, we would like highlight two companies which I think will be the beneficiary for the construction machinery demand. The first one is Lonking Holding. It is not the large size one, but it's actually having a very strong edge with its product very geared towards infrastructure projects in China. They have about 60% of their sales come from wheel loaders, and about 20% of the profit coming from excavator. In fact, what they are doing is that they have a very strong leadership position in China's wheel loader market, and they are now investing more in the technology improvement to increase their overall excavator sales and getting a bigger market share in this actually growing sector. We expect the company's margin improvement will be achieved in both 2020 and 2021. On aggregate, we see the margin will improve by about 1.1 percentage point. So that would be a positive driver for the company's earnings outlook. And then Lonking also have a very good management, excellent management quality over 20 plus years in the industry. The senior management actually has guided the company through major financial crises. And since 2016, the company has proactively cut down its outstanding debt by about 68%. And as a result, the company actually in a very good financial position now, with its net cash now stand at around 55 cents Hong Kong per share, is about 20% of the current share price that's in terms of the net cash. In terms of valuation, we can see that the stock is trading at about 1.15 times price to book, which is actually slightly above the historical average. But we are projecting that ROE for this year will be around 13 to 14%. That provides justification of the stock's valuation. We are also interested to look at that the company has a high dividend yield of about 8.1%. For 2019, and that is going to go X on 1st of June. And going to 2020, we are looking at a 6.5% dividend yield because we are conservative in terms of our earnings projection and using a similar payout of about 60% of what they have in last year as our projection. But that actually still looking for something like 6.5% dividend yield. So this is one of the stocks that we like within the sector. Then the second one is Sany Heavy Machinery. Sany is a leader in both the excavator as well as concrete machinery market in China. If you look at the breakdown, you can see that excavator actually account for roughly about 43% of the company's profit. So Sany will be a very prime beneficiary exposed to just the improvement in profitability for the excavator sector. And then the company also have about 28% of its profit coming from the concrete machinery, and that is very much focusing more on the real estate market. So the company with a combination of close to 70% of its profit coming from these two products has a very good position to capture the opportunities in both the infrastructure as well as the real estate market improvement. We do see that it has potentially a good gearing towards the margin improvement on the back of the excavator price increase in April, as well as potentially in June. And that would see improvement riding on government's infrastructure spending as well as stimulus measures. So we are actually looking at a continuous improvement in margin following a good jump in 2019. And then going into 2020 to 2022, we will see an improvement in the company's margin that will drive the bottom line. The company also have a quality management with a good expansion strategy overseas. This is interesting because the company has a relatively high proportion of overseas sales when compared with Lonking. Lonking's overseas sales is roughly about less than 5%. But Sany has about 15% of its profit coming from overseas sales, just looking at 2019. So Sunny is in a very good position to capture China's Belt and Road Initiative opportunities going forward. In terms of valuation, probably this name is a little bit on the higher end. It's trading at about 3.6 times price to book. It's actually on the highest in the last 3 years, as we can see on the price to book band chart on the right-hand side. Meanwhile, our projection for the ROE is going to be about 25% in 2020. So this is provide some kind of justification for the rich valuation of Sunny Heavy. But overall, we do see that if you look at the stock with the best exposure to excavator market, it's going to be Sunny Heavy. So that is also the reason why it has a very, very nice run, as well as the rich valuation when compared with Lonking. Lastly, we'll share with you about the relative performance of this, of actually 3 stocks that we are looking at. First of all, in 2017, since 2017, Lonking share price has increased by about 92%. That is outperforming 71% for Zoomlion, another construction machinery company, but it underperforms Sunny quite significantly, 223% up by Sunny. The outperformance of Sunny is particularly due to Sunny's solid development in terms of exposure to the real estate sector, particularly over the last 2 years, and also the overall good performance of the Asia market in China. Whereas the weaker performance of the Zoomlion is mainly because of the product exposure that the company is focusing more on concrete as well as crane. So that is actually, to a certain extent, not as good as Sunny as well as Lonking in terms of the infrastructure exposure. So we do see that actually Lonking also have room to narrow down this gap in terms of the performance, given that Lonking is still relatively underperformance among these 3. I would say that this compared with Sunny in terms of its performance, and in terms of valuation, it is relatively cheap when compared with Sunny as well. So this is what I want to share you in terms of the presentation. So and then I think I will just hand back to John for the Q&A session.
Hi, Osbert. Thanks very much for that. We've had a few questions come through, so I'll just get straight into it. So our first question here is this thesis in any way dependent on One Belt, One Road? And do you think that's going to change significantly post-COVID-19?
Well, I think that would actually slow down in terms of the overall export growth, particularly for the One Belt, One Road exercise after the COVID-19, given that we are actually seeing more and more pressure from the coupling of the US as well as China, and probably US going to exert more pressure on China's overall One Belt, One Road initiative. But I would see that overall, the impact for the listed company probably is not going to be very significant. Particularly if we look at some names like Lonking, actually they have a relatively small proportion of export sales, and quite a lot of the export sales is also to some developing countries, including countries in Africa as well as in Middle Asia. So that part, I think, in terms of generic demand, is still going to be quite strong. And one last thing we want to look at is quite interesting. Besides One Belt, One Road, you will see that even in the UK and the US, actually we're looking at that they're going to spend quite a lot in infrastructure going forward after the COVID-19 outbreak to boost their overall economy. So in that case, actually, that would absorb some of at least the domestic US machinery demand, and that would probably be good for the Chinese exporter actually to export to areas like One Belt One Road areas, which with the global supply being very much absorbed by previously not a strong demand from the developed country, and now the developed countries may see improvement in demand that absorb the overall supply.
Understood. Thank you for that. We've had another question. It seems like very likely someone who was listening to our last panel. Have the likes of Longking, have these construction machinery companies in China spoken about sustainability?
Well, I think these companies, they have actually, most of them are like private enterprises, and many of them are like Sany as well as Sun Lion. They are more domestic Asia company listed, and they actually have annual in terms of the ESG report need to also file. At the same time, if you look at Longking, they also mention about the sustainability in the area of like more in terms of the, for example, the environmental concern. Very much they would actually increasingly move towards, for example, the more, I would say, the environmental friendly driven engines, for example, installed in their machinery. But I think, honestly, I would say that overall, if you look at purely from the sustainability area, I would say that they do have concern. For example, they mentioned about something to keep the employees safe, because if you look at they have made a lot of measures so that they actually had the very beginning, like in late, I think late February, they are already able to resume 80 to 90% of the production. And then what we have been noticed that actually nobody in the factory has caught any of the COVID-19 or the problem. So in that case, actually, I would say that it may be comparably not as good as those big cap companies, but at least they are showing concern about the sustainability issue when they are doing the day-to-day management.
Thank you. There's been a few questions touching on the next topic, so I'll try to sort of summarize them all into one. But you know, you've painted a very sort of positive outlook, I guess, for the sector on the back of you know, government spending. But what are the downside risks that investors should keep in mind? You know, what's the bear argument against your buy thesis on a stock like Longking?
Well, I think if you look at the bear argument, probably it's very much Longking. First of all, is that the company is relatively smaller in terms of market share in excavator, which we do see that it is actually have to invest as well as to provide more marketing effort to gain market share in the excavator market. So this is one area that we would need to watch out for, is the potential, how the expansion is successful, the degree of the marketing expenditure, as well as selling expenditure they need to spend. Will they overall drag down the margin of the company? This is one thing we need to watch for. And the same thing is about the potential or the ongoing actually replacement of a wheel loader by excavator. In fact, wheel loader, Longking is the major earnings contributor for Longking, as well as Longking is one of the largest shareholder, a market shareholder in the wheel loader market. But because of the more single purpose usage of wheel loader compared with more multi-purpose usage for excavator. So actually there has been a trend of replacing wheel loader with excavator. So this is one area that we will see potentially that would have some pressure on Longking on the back of the shifting of the future purchase to more excavator than wheel loader, which Longking has a smaller market share in excavator compared with its leading position in wheel loader. So these things are the things that we need to watch out for. But if you look at the overall picture for the industry, I would say that the key things that we may be seeing potential downside is we need to watch out like any rebound of the case on the COVID-19 outbreak, And also one have to keep in mind is that the government budget of, for example, the special purpose bond issuance, there will be time lag between the actual raising the proceeds and then the timing that they spend on purchasing the machinery. So that would potentially have a time lag of reflecting onto the bottom line for the construction machinery company's profitability. So that would be something that we need to keep in mind and watch out for when investing in this sector.
Understood. Understood. There's some more focused questions here on Lonking itself. Someone here is saying that they understand that they have a forklift business, which is also an important earnings contributor, which obviously is not going to have that much to do with infrastructure spending. How's that business performing and what's its outlook, especially given China's trade activities have been negatively affected?
Yes, yes, correct. Forklift is actually one of the, I would say that also important earnings contributor for Lonking. But it is actually used in like warehouses as well as a logistic business. It accounts for about 11% of the company's earnings, but that has been definitely dragged down by the slowdown in trade activities early in this year. But we do see that actually starting April, the overall improvement the unit sales actually has been improving and the momentum is catching up. We're actually looking at that going forward. We're still positive towards the forklift business, although the growth momentum may not be as what they have done in previous 4 or 5 years, talking about 10 to 15% year-on-year growth in terms of volume. But because of the e-commerce business, as well as a lot of domestic use of the forklift in the domestic warehouses catering for e-commerce locally, actually the demand growth will still be a steady number. But actually we do not expect too much in terms of the growth in contribution from forklift, but that is going to be a steady cash flow contributor that generating, I would say that help to sustain Lonking's annual net cash generation ability.
Thank you, Osbert. We've probably got time for one quick last question. You probably have to just grab it. But on that basis of cash generation, the company appears to have a lot of cash on hand. What's the chance that we're going to see them increasing their dividends or otherwise returning that to shareholders?
Yes, I think there is potential, but in fact, the company has always been relatively prudent in terms of their cash as well as financial management. Note that the company's stated policy of dividend payout is actually no less than 30%, and last year they pay out about 55%. And this year we have the COVID-19 outbreak, and still I think it's quite a bit of uncertainty. So I think at the moment we see potential, but I think likely this year they will still be maintaining at the current, I think 55 to 60% payout ratio. But that should give you comfortably about 6.5% dividend yield in this year. I think for further increase, that would be something that we will see as the companies move on in terms of the profitability improvement. But to be conservative this year, I'm still expecting that they are maintaining the same payout ratio.
Great, thank you, Osbert. We're going to have to wrap it up just there. So look, thank you very much for that. It was a great, actionable presentation. I think it's a compelling recovery story for China as they look to reinvigorate their economies. Everybody, thank you very much for spending some time with myself and Osbert today. If you've got any further questions, if there's anything that you'd like to discuss with him, you can find him on page 49 of the ebook. His name is a hyperlink to some contact details that will be able to put you in touch with Osbert. So thank you everyone for joining this presentation. Please do stick around for our next and our final discussion of the conference. We've saved a big one, perhaps the best one till last. We've got a star-studded panel focused fittingly after Osbert's presentation on pump priming Asia. So stick around, guys, and thank you.
Thank you, everybody. Thank you, John, and goodbye.